just give our friends, right, okay, another 1 minute or so for them to come and join in for our session. Okay, thank you for joining our live session. My name is Andrew. I'm from Phillip Futures. And today our topic will be on contracts for different CFD. And this session, right, is designed for beginners. So before I carry on, I would like to do some sound check. And if you can hear me loud and clear, right, please kindly type them on the question box and can you hear my voice clearly? Hello? Just hang on for a while. Hello, sound check, sound check. Okay, great. I guess everyone can hear me loud and clear. Okay, so anyway, during the seminar, right, if let's say you have any questions, please feel free to type them on the question box and I will address them during the Q&A session at the end of the webinar. Okay, so let's begin today's session. Okay. Okay, this is the disclaimer. Okay, I just like to mention that all the content being shared, right, okay, is purely for educational purpose, and this session is actually designed and targeted for beginners. Okay, so something about myself. I've been in this industry for around 10 over years, and before the pandemic, I was actively involved in giving lessons and class, sometimes 2 to 3 sessions in a month. And if you have ever come over to our office at level 7 or PIC, which is a Phillip Investor Center, you notice my area of focus, right, ranges from beginner content all the way to macroeconomics, investing and trading strategies, as well as technical analysis. And during my day-to-day work, right, my job is to update my personal pool of clients on market opportunities, market updates, as well as refining their trading strategies. So as usual, after the seminar, right, I will be blasting out following up emails. And if you have any questions, right, okay, just feel free to drop me a note. Okay. Yep. So before I carry on, let's do some little quiz. Okay. I'm sure every one of you have read something on the mainstream media. Just like to do a short poll whereby in this year 2020, right? Okay, what are the most frequent word that you see on the mainstream media? I will give you 4 choices. Okay. First would be pandemic. Second, Trump. Third, unprecedented. And fourth, right, okay, it will be recovery. Okay, so let's do a short poll. I'm sure everyone can see on your screen, right? You can drop your answer there. Pandemic. Okay, 63%, 64% pandemic, 30% Trump, 8% unprecedented. Interesting, this crowd. None of them says recovery. Very interesting. Okay. Yeah. Anyway, just let me carry on, right? Okay. Before I carry on, I just like to show everyone this chart. Okay, just hang on. Okay. I'm sure everyone can see this chart, right? Okay. The reason why I put this the reason why I mentioned this forwards is because, right, okay, in my 40 years of my life, I have never seen this kind of fear and impact on the community as well as on the financial market. And of course, the main driver of such fear and impact is due to COVID-19, a health emergency globally, okay, which actually leads to business being shut down. Okay, COVID-19 actually started in around end of December. It actually started around end of December. That's the reason why the name COVID-19 over here. And it's beginning to spread in the month of January and February. And during these 2 months, right, market is still making its very new high until the end of February. Until the end of February, whereby the real impact actually hits the market, and then what the market do is it falls around 1/3 of its percent, one third of its value. Okay, because during this pandemic, right? Okay, because during this pandemic, businesses are forced to shut down, citizens isolate at home, and this time round is actually a very unique crisis. And due to such drastic measure, it causes a very big brutal economic slowdown throughout the whole world. Okay, such lockdown actually began in January. China actually started its lockdown in January, then to the rest of the world, and then April, Singapore start its lockdown in April, which is the circuit breaker, which caused our Singapore GDP to be negative 41%. Okay, let's visit some of the financial crises, right? Okay, 20 years ago. I'm sure everyone remember the dot-com bubble. Am I right to say that? Okay, during the dot-com bubble, S&P 500 actually drops 50% of its value. Half of its valuation gone within 2 years. It took around 2 years for the price to reach 50% down. And fast forward, right, in the year 07 to 09, during the subprime crisis, it takes around 18 months, a long stretch of bad news, right, okay, for prices to drop around 60%. But this time round, what did the market do? Within a month, from 3,000 over points, market actually have a drastic sell down all the way to 2,000, slightly below 2002, which is 1,000 points. 1/3 of its value, 33% just gone within a month. And such impact, right, is actually it is pretty unique. Okay, it's pretty unique. And ever since, right, okay, market has been slowly recovering, forming a V-shaped recovery. And as what we are saying right now, market has almost, right, returned back to its pre-crisis level. I'm not saying that the crisis is over, but as of right now, S&P, right, it is around its pre-crisis level in the month of February. Okay, so let's look at another chart. Okay, this time around I have added something I have added something interesting, which is the investor sentiment analysis, the put call ratio. Okay, in finance, right, the put call ratio is a technical indicator that demonstrate investor sentiment. This ratio, right, actually represent a proportion between the put options and the call option purchased on any day, on any given day. So this is how you read. This such indicator. When the indicator, right, actually showing a low level, which is showing a low level somewhere between 0.5 to 0.4, it actually reflects a bullish momentum. Okay, but when the market actually showing a high reading, which is 0.9 and above, you are actually you are actually witnessing, right, a bearish momentum. Okay, so this is the SPX index. Just hang on for a while. Okay. Okay, so this is the SPX index. Okay, taken from 09 to 2000 and 2020. Okay, 2019 has been a fantastic year for almost all the market, including S&P, Dow Jones, as well as Nasdaq, because all the index, right, actually created new highs. You still remember S&P 500 actually created new high in the month of April, May, and then in the month of July, and then did some correction. Later created a few new highs in the month of November, all the way to February 2020. Okay, and this green line, right, is actually the moving average, the 200 days moving average. Notice the correlation, right, between the movement of S&P index, SPX index, as well as the put call ratio. When the market actually created a new high and it did some correction, it never went through the 200-day moving average. It never went past. It bounces off the 200-day moving average. And look at the put call ratio during its retracement. It retraced the put call ratio. The put call ratio increases its reading to a major bottom. And then after which, right, when it bounces off somewhere around here, the reading actually retraced back. And look at the correlation. 1, 2, 3, 3 spikes here, 3 spikes here. 1, 2, and 3. This, so which means is that, right, okay, any reading that is around 0.9 and above, right, okay, we are actually seeing a major bottom on the market in terms of sentiment analysis wise. Okay, let's fast forward to December and January. Okay, December and January, we are seeing that the market is creating new highs, while the moving average, right, okay, is slanting towards the upside. It is still moving towards the upside. And look at here, there's actually something very interesting. Okay, the put call ratio actually consolidated around 0.5 to 0.4 level, while the market keep increasing its value, keep creating new highs. Then after which, right, okay, when the lockdown happened in China in January and the real financial meltdown due to the COVID-19, it causes the market to have a drastic sell down, went past this 200 days moving average to somewhere around 2002. And look at the put call ratio, it has a very, very drastic spike. And after this, what happened? It begins to normalize again. And fast forward as of today, June, July, August. June, July, August, right? We are witnessing another consolidation again. Look at here. I'm sure everyone can see this cross over here, right? Okay, it happened in the month of May, whereby the market actually recover past the 200-day moving average. And notice, okay, that the market never returned back to its value below the 200 days moving average. And we are still observing that. Just hang on. Okay, and we are still observing that the put call ratio is still consolidating at a low reading. This actually shows a bullish momentum. So just now during the polling, I was actually a little bit surprised that no one talks about the recovery, but it's okay, right? Okay, so but of course, if let's say you have any questions, right, okay, do remember, put down onto the question into the question box. Okay, so now this is my personal view. Okay, so this is my personal view, short term as well as long term. Moving forward, right, because right now we are in the month of August, and very soon, within a few months' time, we will be welcoming 2021. Okay, so this period of time, there are a lot of other risks in the market that we need to take note when we are investing. So this is actually my personal view that first, okay, global growth will continue to be slow, and demand, right, might continue to be weakened. This is my view. Second, right, okay, the thing that we all need to look at is the US election. What is the sentiment on the US election? Because there's a saying, when US sneezes, the whole world catches a cold. Okay, so we need to look at how the US market perform, especially near towards its election day. Okay, next, okay, how visible is the vaccine? And I understand that the whole world is racing to create a vaccine for COVID-19, okay, including Singapore. But how effective is the vaccine? As of today, there's no concrete answer on that. So if the vaccine approved, of course, the market would likely continue to rally. But if there is any failures, it might delay the process more. Okay, and of course, the new Cold War between China and US. Okay, so basically, right, okay, is this all the risk that is in the market? Is this all the risk we are seeing in the market? Because what I have mentioned this 4 points: the global growth, the US election, the vaccine, as well as the new Cold War, it's more towards short term. That means a short to a mid-term kind of risk that we will be seeing. Okay, there's actually a point that I did not put into this slide, okay, which I think that most of us has more or less brushed it aside or even forgotten. That is, right, okay, the thing that I'm actually concerned of moving forward, especially at the end of 2021, right, okay, it is the LIBOR transition. Okay, it is actually the LIBOR transition to soft. Okay, LIBOR transition to soft, because LIBOR, right, is going to be not in use. Is going to be not in use till December 31st, 2021, and many market participants, right, okay, remain unclear about the risk, the level of risk involved. Okay, that when you convert existing contracts, what are the risks that is actually involved, and they are also not sure about new businesses with recommended replacement rate. Okay, so this is actually another form of risk, right, that we need to take note as we are investing and trading the market. Okay, why do I mention this SIBOR and LIBOR? The reason is because, right, okay, this market is around 200 trillion worth of notional value in derivative as well as cash contract, and the product that touches all client segment, including, right, the layman like you and me, individual borrowers. I'm sure everyone listening to me have a student loan, have a car loan, have a housing loan, and all these would have impacts on the loan itself. Okay, and as for Singapore, we are also switching from SOR, which is SOR, from SOR, swap offer rate, to SORA, Singapore overnight rate average. Okay, why Singapore have to switch? It is because, right, okay, the SOR, which is SOR, is the key interest benchmark rate in Singapore. Okay, this is the key interest rate benchmark for Singapore, and the computation, right, okay, actually uses US dollar LIBOR in its computation methodology. So such transitions, right, also affect us in Singapore as well. Okay, it affect from institution to our loans to our layman. So moving forward, right? Okay. So moving forward in my slides. Okay. First, in a short period of time, short term, from now till the end of the year, right? Okay. My personal view about the market, it is still long bias, but from mid-term onwards, right, all the way to a long term, which is near 2020, which is near 2021, the situation is really unknown. Reason is that, right, okay, besides slow growth, besides whether the vaccines is viable or not, the interest rate environment is still a very unknown factor, especially LIBOR transition. It's it is a very unknown factor because, right, there will be a lot of operation issue that will slow down the transition. Some of the operation issues, right, okay, that will slow down the transition, the transition, right, okay, would be the finalization of, finalization of the accounting, tax and regulation, okay, the volatility of the overnight soft, okay, as well as the lack of industry's consensus. So these are some of the factors, right, okay, that will impact the market. And because the notional value is around 200 trillion, so that is the reason why, right, okay, every one of us will be affected. But how big the impact will it be affecting us? To be honest, no one knows. Okay, no one knows. So why do I mention all these things from COVID-19 to the market sell down within a month, 1,000 point down, and some of the futures risks, right, okay, that we might be facing. The reason is that, right, okay, we are actually living in a world whereby volatility increases drastically in a very short period of time, and it will actually make sense for retail investors like us to start exploring new financial tools to invest in. And one of which, right, okay, it is CFD, which is CFD, right, is actually a very popular financial tool for investors to invest in. Okay, so if you would want to learn about how to trade CFD, right, in this day and age, the fastest way would be by viewing a video or attending a webinar. And you can actually visit our website. You can actually visit our website at Phillip Futures, our website, because we have a full suite of educational video ranging from CFDs, FX, futures, okay, and order types and all the stuff, right, okay, that helps you kick start your journey in trading. And if let's say you feel that it's not enough, okay, almost every single week we will have webinars or seminars, something like this, for you to attend. And if you feel that it's still not enough, right, okay, what you can do is that you can actually, utilize our personalized trading services. Okay, that means, right, okay, you can actually open your account with us. You can actually open your account with us, and our account manager, right, our account manager will guide you step by step, one step at a time. Okay, from account opening to CKA, CAR, to order types, to different contract specification, etc., etc. So these are the few venues, right, okay, that you can, that you can kickstart your learning journey. Okay, so let's talk about CFD. So what is CFD? Have anyone traded CFD? Any one of you have actually traded CFD? Okay, yeah. CFD, right, contract for difference, it is actually a contract between the buyer and the seller to exchange the difference in price. Okay, the difference in the opening and the closing price of a contract. Okay, yeah. And for example, okay, CFD, right, let's say your view about a CFD, S&P CFD, at the price of 2005 and you think that the market actually will recover to 3000, what you can do is that you can actually purchase at 2005 and take profit, liquidate at around 3000. And there are actually a few features, right, okay, that you might want to take note. Okay, there are a few features that you might want to take note. Okay, first, for CFD, okay, what is CFD? First, CFD is a OTC derivative whereby the value actually derived from the underlying asset or mimic the price movement of an underlying asset. So what is an underlying asset? An underlying asset, right, is something like a stock index, for example, Dow Jones, Nasdaq, Hang Seng, all these are stock index, all the way to Forex, FX, USD, Japanese yen, Euro, USD, Pound, USD, or the underlying asset can be a commodity, like for example, silver, gold, crude oil, Brent crude, all these are underlying asset. Okay, and with us, right, okay, you are able to trade all this asset. Later, before I end the seminar, I will be doing a live demo on the MT5 platform. Okay, so okay, next, what makes a CFD contract, right, so attractive? It is because it is a leverage contract. Meaning to say that, right, okay, for example, the valuation of a contract costs around 20,000. All you need to do, right, is to put 10%, which is $2,000 into your account to open a trade. But of course, with leverage, right, it actually magnify your profit as well as your loss. So this is something that you need to take note of. You need to take note of, okay, because with leverage, it magnifies your profit and loss. And last but not least, right, okay, which is very important, is that it allows bi-directional trade. So which means is that, right, okay, even if you are a day trader, position trader, or a scalper, right, you can actually make use of such bi-directional trade to trade both the bull as well as the bear market. Okay, you're able to trade both the bull and the bear market. If you think that the market is likely to go down, is likely to lose its value within this short period of time, all you can do is that you can sell now, sell high, and buy back low, and that's where you make the profit. Okay, and let me illustrate about leverage. Okay, for leverage wise, right, okay, all you need to do is to put in a margin of around 10% of the whole entire value. Just 10% of the whole value. Like I mentioned just now, let's say the contract value worth around 20,000. All you need to do, right, is to put in $2,000, which is around 10% of its value. Then you will be able to trade the CFD of this particular stock or index or commodities. Okay, so let me recap. There are a few features of CFD that you need to know. Okay, first is that it's a OTC derivative. Second, it is a leverage product, and of course, leverage always comes as a double-edged sword. It magnifies your losses as well as your profit, and of course, it also encourages, right, okay, bi-directional trading. Okay, so you are able to short sell, you're able to sell, okay, high and buy back low if you think that the market is going lower. But of course you must understand, okay, CFD without risk management tool, right, without risk management is very risky. So when you are doing any investment with CFD, it's utterly important for you to put in your risk management order, which is your stop loss as well as your take profit. And one thing that you also need to take note is that, right, for CFD, right, okay, for our CFD, it does not comes with commission. Yes, you are hearing correctly. for our CFDs, right, okay, you do not need to pay any commission on the CFD itself. Okay, so now let's talk about how to trade CFDs. Okay, the golden rule, right, in trading any CFDs or any contracts, right, okay, it is always buy on the ask and sell on the bid. Okay, buy on the ask and sell on the bid. Okay, the reason is that, right, okay, all the prices that you see on the chart itself, is actually live prices. But okay, when you see the chart, like for example over here, okay, when you see over here 1.7760, the candlesticks, right, okay, that appears on the chart is always plotted using the bid price. It's always plotted using the bid price. Okay, so this is the candlestick chart. Okay, so this is the candlestick chart. This symbolizes a bullish candle. This symbolizes a bullish candle, which is, this is the close. This part is the close. Okay, this part is the open. Okay, this is the open, this is the close, this is the low, and this is the high. Okay, for a bearish candle, right, okay, for a bearish candle is just the opposite. Okay, this is the open, this is the open, this is the close, this is the still the same, this is the low, as well as this is the high. Okay, yep. Why is it important, right, okay, to understand, to actually make yourself understand about the difference between the bid and ask? Because, right, okay, you will come to a point of time whereby, right, okay, the market actually goes so close to the price that you want to take. The market will actually go so close to the price that you want to take, but after that the price was not being taken. Why? It is because, right, for example, let's say you want to buy at 1.7735. Okay, 1.7735, but the ask price, right, actually only goes to 1.7763. You will not be able to purchase that price. You will not be able to purchase what you wanted. And notice, right, okay, the difference between the bid and the ask. Okay, the ask price, right, okay, is always higher than the bid price. And the difference between the bid and the ask, right, okay, over here, for example, this Euro New Zealand dollar, the difference between the bid and the ask, right, okay, is around 3 pips. Okay, the difference is around 3 pips. This is the trading volume. This is the trade volume that you can adjust. That means, let's say you're able to purchase 1 lot, 2 lot. This is the trading volume. And over here, it is the ask price. Over here, it is the bid price. So remember, you always sell on the bid and you always buy on the ask. So there are many new traders ask me, whether is this fixed? My answer is that the spread between the bid and the ask, that means, what is spread? Spread is actually the difference. Spread is actually the difference between the bid and the ask. And this spread, right, okay, it's been affected by a few reasons. First, okay, is the underlying. First is the underlying. Like for example, this currency pair, Euro New Zealand dollar, is quite it is not a quite popular pair. So that is the reason why, right, okay, the difference between the bid and the ask, right, okay, is wide. But if you are trading on something that is more popular, like for example, Euro USD, okay, the spread between the bid and the ask, right, okay, can be as narrow as 0.6. Okay. Second, it is the time of the day. If you are trading Euro USD, during Asian hours. During Asian hours, like our 8 a.m., 9 a.m., Europe and US market is still closed. So that causes, right, the spread to be widened. It causes the spread to be widened. Okay. And next, last one, it will be the events, economic data. So during economic data, like for example, CPI, non-farm payroll, PPI data, during such release of the data, the spread between the bid and the ask will definitely widen because the liquidity, right, in the market is being taken away. So these are actually some of the factors, right, okay, that will affect the size of the spread. Okay, now let's do some example. Okay, when you are placing an order, okay, for example, let's place an order for Euro USD 1 lakh, and the price is trading at 1.4530, and you want to enter long. Okay, you want to enter long. Which price will you be done at? Will you be done at when the market actually reaches the bid price, or when the market reaches the ask price? Okay, yes, you're right. It is the ask price. Mean to say, right, when the price reaches to 1.4530 at the ask price, okay, then your order will be done long. And after you have done your long order, what is the next logical thing to do, which I understand that many of us never really do it, which is what? Remember what I mentioned about the risk management order? This part, the risk management order. You need to set your take profit as well as stop loss target. So in this example, right, okay, I want to have a profit to risk ratio of around 2 to 1. Okay, so I'm willing to have a stop loss at 1.4480, which is here. Okay, and I want to take a profit at 1.4630. So both of this price, okay, have to be done on the bid side. Both of the price have to be done on the bid side. Okay, if the bid have not reaches to this price, in this case for stop loss 1.4480, as well as take profit, right, 1.4630, the order will not be done. Okay, let's look at another example. Okay, let's look at another example. This time round, let's go short. Okay, let's go short. Okay, now I'm shorting this. I would like to short CFD S&P index. Okay, currently it's trading at 3003. Short one lot at 3003. Okay, and I would like to have my profit and loss target, right? And I like to have my profit and loss target to be 3 to 1. Okay, 3 to 1. So let's say the order reaches to 3003. Once the order reaches to 3003, which price must it reach to? Yes, you got it. Okay, you need to reach at the bid price. So once the bid price reaches to 3003, your order is done. Remember, you sell on the bid and you buy on the ask. You'll never go wrong. Okay, then you will have a stop loss of a 20 points stop loss. Okay, then you have a 20 point stop loss, and you have a take profit of a 60 point. Okay, so your ratio will be 3:1. Next, right, okay, remember during in the beginning of seminar, I mentioned that for CFDs, right, okay, you are able to hold it long term. You're able to hold it long term, but there will be a holding cost. And this is how you calculate the holding cost. This is actually an example. Okay, this is actually an example. Let's say, right, okay, trader A, okay, let's say trader A buys one lot and of a Bank of America CFD contract at this price, 21.07. Okay, so how do you calculate this swap rate? Is by the contract size times the tick size and the value on the swap long. So in this case, right, okay, it's negative 1.9, and if you are selling it, right, okay, it is negative 1.7. Okay, so you do your math calculation. This is the holding cost per day, minus 1.9. So basically, right, for CFD, yes, you can actually hold it almost to forever, but you must also understand that, right, okay, there will be a holding cost incurred. Okay, and during certain period of the time, during certain period of the season or the time, right, such holding costs might change as well. Okay, next. Okay, next, margin. Okay, this is a leverage product. This is a leverage product, and I would like to talk about margin calls. Okay, for simplicity, right, okay, for margin calls, right, there is two things that you need to take note. First is the initial margin. Second is the maintenance margin. Usually, right, usually for us, right, the initial margin as well as the maintenance margin is the same price. Okay, but for this webinar's sake, right, I actually put two different prices, which is 2,640 as well as 2,400. When the market, when you're holding one lot, okay, and this is the amount that you have in your account. If you purchase one lot and the market actually goes against you, and your value, your account value reaches to below 2,004, what will happen? What will happen? Yes, okay, you will be given a margin call. When the value actually reaches below the maintenance margin, yes, you will be given a margin call. But for us, right, okay, because we are using MT5, firstly, some good news. First, there is no margin call, okay, but if your value, right, okay, reaches, if your equity balance reaches to below 20%, there will be a auto liquidation of your position. Okay, there will be auto liquidation of your position. So that's the reason why I'm saying that for CFDs, right, okay, when you are trading any products, whether it's a futures, FX, CFDs, okay, you need to take note that first, there are enough money in your account. Second is that, right, okay, never allow your account for risk management practice wise, never allow your account to go to margin call. Even when there is a auto liquidation at 20%, never allow your account to go below the maintenance margin. Okay, yeah. So how to open an account? Okay, this is some of the requirement for Singaporean, right? Okay, the minimum deposit, Singaporean as well as Malaysian, the minimum deposit will be $500. Will be $500, and for Malaysians, right? Okay, you will need supporting documents as well for you to open an account, and these are some of the necessary documents, right, that you need for foreigners. And of course, you need to pass your CKA and CAR for this. Okay, so before we visit this MT5 platform, okay, let's do a last poll. Okay, let's do a last poll. Okay, which products are you interested to learn? First, FX, futures, CFDs, or all the above. Okay. All right. Okay. Now, let me see. Okay. The result is 13% FX. Majority 60% is all the above. Majority 60% is actually all the above. Why do I say that? Why do I actually mention this poll? The reason is that, right, for Phillip Futures, right, you're able to trade futures, forex, CFDs, as well as options. Okay, so during the account opening, so let's say during the account opening, right, if you have any questions, right, I will be there to assist you. So let's visit our MT5 platform. Okay, just hang on for a while. Okay, well, I'll pull out my platform over here. Okay, can you see this MT5 platform? Okay, this will be something like this. Okay, whether you are using a live MT5 or a demo MT5, this is the exact same thing that you will be seeing. Okay, over here are all the charts. Okay, and if you think that the charts is a little bit too small, all you can do is that over here, arrange it, click it. Okay, then it will actually shows you a full chart. Then it shows you a full chart. Okay, so assuming that you cannot find the product that you want to trade. Okay, notice my cursor over here. Go over to this part. Okay, and select the product that you want. Select the product you want. Okay, for index, you have Dow Jones, S&P, Nasdaq, Hong Kong, Australian dollar, commodities, as well as shares also. Shares, right? Okay, there is Singapore shares, US, as well as Hong Kong shares. So you cannot see any Hong Kong shares over here, right? Because if not, right, okay, you'll crop my whole screen. So I actually disable that. So all you need to do is to come over to this icon. Notice this icon. 看到吗? Okay, notice this icon. Okay, click on it. Yeah, click on it. There will be a window over at this part. This is the Hong Kong shares. So these are some of the Hong Kong shares. Bank of China, China Mobile, etc., etc. Okay, and let's say assuming that you want to trade Bank of America, or let's say you want to trade Boeing. Okay, just double click on it and it's been activated. Then just press OK and you can select your CFDs over here. Okay, Boeing. Okay, this is the chart for Boeing. Okay, I see someone wants to trade Hong Kong. Wait, let me just enable one. Okay, Bank of China. Just hang on for a while. Let's say CFD. Okay, Hong Kong, Bank of China. Okay, this is the Bank of China chart for CFD Bank of China chart. Okay, so let's say, right, okay, you are thinking that this chart is too black and you do not want such property. All you need to do is right click on it and goes to property over here. Goes to property over here. Okay, notice I mentioned about the bid and ask, right? Okay, because the charts that you see, right, the chart that you actually see over here, all these are under bid price. You need to activate it. So you need to show the ask price, which is somewhere around here. Okay, so the ask price, you need to activate it. And then for me personally, I do not like green on black. I like black on white. So I click here. So I just press OK. Okay, next, Okay, for our MT5, right? Okay, there are full 100 over indicators that you can use, such as oscillators, such as bear power, bull power, CCI, MACD, MACD, or if let's say you are a trend trader, like most of my clients, right? Okay, you can use moving average, parabolic SARS, and all this, etc., etc. Okay, so let's say I want to use moving average, and I'll put 20 exponential, apply to close, because you can apply, because for the calculation of this moving average, right, you can actually apply it either using close price or medium price, which is high and low divided by 2, or its typical price, high, low, close divided by 3, or its weighted close. So for simplicity, right, we just put at close price. Okay, and yeah, these are some of the things that you can put it. Yep, and here you go. Okay, also for MT5, right? Okay, you will have a calendar.
Sorry, I don't understand.
Okay, you will have a calendar. Sorry, it's my okay, you actually have a calendar over here. Okay, now next, how do I place an order in MT5? Okay, you can actually place the order for MT5 either through this one-click execution, or the new orders over here. So let's say I want to do a pending order. I can click pending order. Okay, a buy stop or sell stop, or buy limit, sell limit. So assuming I think that the market, right, okay, will continue the upwards trend because the US dollar is weakening, and then right now market is having a one-day correction, a bearish engulfing pattern. Okay, a bearish engulfing pattern, but I am contrarian. I would want the market, right, okay, to continue to go higher. So what I can do is that I can put a buy stop, and assuming let's say I want to put a buy stop, let's say at a price of 1.1250. Okay, I want to have a buy stop at 1.1250, and I would like to have a take profit stop loss of a 50 pips, which is 1.1800. Okay, and my ratio, right, I would like to have a 3-to-1 ratio, take profit. So 1.19, 1.1, 1.2. Okay, 1.2. I would like to have a take profit of 3:1. Okay, around 3:1 ratio, which is around 1.2. Okay, so I place the order. Once I place the order, you can actually view your order at here. This is your pending order. Okay, this is your pending order. Yeah, you can actually see your pending orders all over here. Yep. Any questions as of right now? Any questions as of right now? Okay, no questions, right? Okay, no questions, right? Okay, let me continue with my slides. The reason is that, right, okay, for MT5, I would need to have a separate session to go through all the different functions of this platform. Currently, right, okay, our time is really running out, and I could not go through every single function, like how to draw on the chart, etc., etc. Okay, so I would need another session to only talk about how to operate this platform MT5. Okay, so let me just continue with my presentation. Let me just continue with my presentation. Okay, yeah. Okay, so anyway, right, okay, what you can do right now is that, right, you can actually sign up an account with us. You can sign up an account with us, and if let's say you wanted to have a personalized trading support from my side, okay, all you need to do later on, there will be a QR code on the last slide. Okay, just scan the QR code to open a live account with us. Okay, and then once you have opened a live account with us, right, okay, so on the day-to-day basis, I will be, you know, updating all the traders about your trading strategies, about the market, about market performance, what are the possible risks that you might see today or maybe 1 week later, etc., etc. Okay, so this is the barcode. So this is the barcode that you can scan. Okay, and we have come to our Q&A session. Do you have any questions that you'd like to ask me? Because my time is really running out. Our time is running out. Okay, let me see the question box. Okay, okay, looks like there is no question asked from the audience. Okay, if let's say you are shy to ask any questions, right, okay, not to worry, because like I mentioned, after this seminar, right, I will be blasting out following up emails. Okay, so if you have any questions, right, you can just feel free to reply me on the email, and then a recording, right, a link to this recording will be also made available to you along with the email as well. So okay, that's all we have for today. Thank you for being such a wonderful audience, and I am looking forward, right, okay, to see you again once we are able to do a face-to-face seminar session at level 7 or at PIC. Thank you very much, and this is Andrew signing off. Have a good evening.